This screencast is looking at question 2 from the January 2014 CAP2 Financial Report and Interim Assessment. So it's looking at TAccount Jan. And this is again a group accounting consolidation type question. So again, always go to the requirements first, take a look what you're asked for. So 30 marks, you're talking about roughly 25 to 27 minutes. And there's 3 different components. So calculate the NCI post-acquisition profit for the period ended 31st December 2013. Prepare the goodwill working, and also then set out the consolidated SOFP. So again, make sure, stop the screencast now, go back and have a read through the question and make sure you're comfortable with what the information is there, because we're going to start into the question then. So the first part is calculate the non-controlling interest post-acquisition profit. So not the pre-acquisition, we'll be doing that in the goodwill working, but you want to figure out what's the post-acquisition profit. And essentially there's 2 real methods of going about this. You know from the question that Dankla only trades with TAccount Jan, and you're told from here that TAccount Jan was Dankla's only supplier of DVDs. Therefore you can essentially work out what the P&L looks like for the period from April to December 2013, and work back that way. So that would be classified as the long way. Alternatively, if you know that, look, Dankla retained earnings at the end of 2013 is 640. When you acquired them in 2013 or in April was 400. So if we look at here, so end of year retained earnings is 640. At acquisition date is 400. Therefore the post acquisition earnings must have been 240,000. So the profit for the year for Dankla between April and December must have been 240,000. And you know the NCI will get, well, the proportion of the purchase made. If TAccount Jan bought 80%, the NCI must get 20%. That means 240 times 20%. So the post-acquisition profit for the NCI, which is the question you're asked for, is 48,000. Now the longer way going about that is to actually do out the P&L from the 1st of April to the 31st of December. So Dankla P&L 2013. So the first thing is, well, what's its revenue for 2013? We looked at the question, what are we told about Dankla? Dankla sells all its goods at a cost plus a margin of 40%. So we're also told in the question that TAccount Jan, which is Dankla's only supplier, sold the goods for what it purchased at 600 grand, and it sold it to Dankla at a cost plus 20%. So Dankla made purchases of 600 grand, that's how much it cost TAccount Jan, times 1.2. So it made purchases of 720,000. So again, I appreciate there's a lot of dates and a lot of names going on in this question, but again, that is reflective of the types of questions you're going to get in an interim assessment and in CAP2 in general, that you need to practice being able to take out the relevant dates and the relevant names. So Dankla would have purchased goods costing 720,000, i.e. 600, with a markup of 20% from TAccount Jan. They also have goods worth 90 grand remaining in inventory, so we'll say closing stock. Remember, there's no opening stock because it's a new entity, so they would have purchased, there would have been no opening stock, and therefore the cost of sales becomes 630. So you would have paid for goods during the year of 720, over 90 that remains in inventory. And finally, you're told Dankla sells all the goods at a cost plus a margin of 40%. Now it's important to note the distinction between the language here of cost plus up here and cost plus a margin. The margin essentially means here that, well, if your margin is 40%, that must mean your cost here, your cost of sales, is 60%. So the revenue is 630 over 0.6, meaning your total revenue for the period of 9 months is 1,050,000. That gets you to gross profit of 420,000, which you'll note the gross profit margin is 40%. And the final cost you have to figure out here, you're told admin costs for the year are 240,000, but these need to be incurred evenly during the year, so admin costs are actually 240 times 9 over 12 because you're only starting in April. Therefore, profit for 9 months is 420 minus 180, getting you back to 240. And you notice that 240 is the same as the 240 up here. So there's two ways of going about it. The shorthand method, which is here, but students had to realise the relationship between the initial date of acquisition and December time. And then there's the longer way. Either one was acceptable as long as you got down to the NCI's portion. The next question that's asked then is prepare goodwill working for TAC Jan at the acquisition date. Okay, so there's two ways of going about this. The one way is to look at it in a columnar method. So I'll show you both, but I prefer to use the TAccount method, particularly when we're asked to do the SOFP afterwards. But one way you can look at it here is, well, how much did we pay for TAC Jan? Well, we paid consideration. We paid 1 million, and that bought us 80% stake. So you paid 1 million. Now we have to figure out, remember, under IFRS 3, you have two ways of accounting for the NCI. Either at its fair value, or at the proportion of the fair value of the assets. And you're told here the policy is to measure the NCI at the proportion fair value of the assets. Therefore, there will be no goodwill attributable to the NCI. And likewise, you're told the fair value of the net assets was equivalent to their book value. So likewise, under IFRS 3, there's now no need to make a fair value adjustment, which again saves you time. So now we want to figure out is, what is the NCI value? Well, the NCI value is 20% of the book value of the assets at the acquisition date. So it's 950 times 0.2. That means the total value here is 1190. Assets acquired is 950, which means goodwill will be 1190 minus 950, giving you 240. So again, you could have done it this way. You could have also just looked at, well, the consideration for just TAC Jan on its own. So you look at T and NCI together. Or you could look at TAC Jan's portion. So they paid 1 million, and the assets they acquired was 950 times 0.8, giving you again goodwill of 240. Either way you look at it, you're getting the same answer because the NCI essentially has no goodwill attributable. It's just valued at its proportion of the net asset value. Now, if you were doing this from a double entry accounting or TAccount perspective, what you would start off with is, just go over here, we would essentially have an opening balance here of 1 million in the investment in Dankla. So I'm just going to put in some of the opening balances just to show you the approach. Your share premium would have T and it would have D. So T would have a share premium of 0 and D would have a share premium of 100. Likewise for the share capital, you'd have TAC Jan and Dankla. That would have 4,000. This would have 400. Same with retained earnings. So you can see it's a bit more long-winded in terms of using the columnar method, but it is useful when you need to prepare a full statement of financial position to use your TAccount method to make sure you've covered off everything, particularly retained earnings. This is 1090 and this is 640. And the final one then is revaluation reserve, which I'll put in here. I have it here. Just put the revaluation reserve in here. And that is T and D. So T's opening balance and revaluation reserve is 0 and D's is 50. So when you're doing your goodwill account now, you bring it all to the cost of control. So the first thing is, well, clear out your investment. So that goes to the cost of control. That's 1 million. 1 million. You know what else has to go to the cost of control? Well, some of this portion of share capital, and that will be 80% of Dankla's share capital go to the cost of control. That's 320. We'll call that share C. Likewise, some of the share premium, some of the reval reserve, and some of the retained earnings. So similar calculation that you're doing in the columnar, you're just putting it in a more structured setting, particularly when you go on to do the full SOFP. So the share premium, cost of control is again 80% of Dankla's only. That is 80. And see, it makes it clear for the examiner where you're getting your figures. Because all these donklas for the equity portion will be stripped out. And the only portion that's going to be left then is post-acquisition earnings in your retained earnings balance. Revaluation reserve, again, 80%, so that's 40. And here we're not looking at 80% of this, we're looking at 80% of the pre-acquisition earnings. So the cost of control here will be 80% of the 400, which is 320. So by summing them up then, the balance in your cost of control account should be your goodwill, which is the 1,000 or the million, minus the sum of all these portions, which gets you to your 240. So this account then is cleared. There's nothing left in this in terms of it's balanced off and it's cleared out. And what you do is you say cost of control, the goodwill is now 240. And that is the calculation done. And now what's useful about that, we come to the same answer, but we're also set up for part C, set out the consolidated statement of financial position. Okay, so what I typically do, and again you don't need to do it for all of them, but all of the main accounts I will put in all the opening balances. So for property, plant and equipment, you can put it in, but there won't be any workings for it. Investment and donkla we've already done. Inventories, we'll open up a T account. So we'll call this inventories, and we'll call it T and D. Just have the opening balances. T is 990 and D is 90. Trade payables, or sorry, trade receivables, there is only 1190, so we'll put in another account for that here. And sometimes people find this cumbersome, but particularly when you go into complex questions in the main CAP2 exam, it's useful to have these done. And you don't have to do all of them, you will get expertise in terms of which ones to do and which ones to leave out. But just for now, we'll show you the longer method. So T is 1190 and nil. And cash and cash equivalents, same method. Cash 550 and 60. Ordinary share capital, all the equities are done. Trade payables, we know is, don't forget, it's a credit balance of 1300 and 100. So now we've all those balances done, and we can start doing our cost of our SOFP consolidated. So one of the first steps we should do is, well, what is our NCI figure? The opening. We've only cleared out some of the share capital, we've only cleared out some of the share premium. We know all of Donkla's equity pre-acquisition should be cleared out. So the NCI must get the separate portion of 400 times 0.2. Likewise, the NCI should get 100 times 0.2 for the share premium. Similar for the revaluation reserve, that 50 should be cleared out, so that other 10 must go to the NCI. And finally, for the retained earnings, the 400 that we've had, 20% pre-acquisition is belonging to the NCI. So bringing them all into the NCI, you have share capital, you have share premium, you have reval reserve, and you have retained earnings. And you should notice that that value of the NCI will come to the same value in the column or method. Share capital is 80, share premium is 20, and it makes it clear for the examiner where the figures are coming from. Valuation reserve is 10, and finally then retained earnings is 80. So if you sum them up, now we won't do it explicitly here because you have to add in post-acquisition earnings, but that comes to 190, which you'll go back and you'll figure out here is consistent with the 190 value we'd already placed in it. So finally, another important thing you need to do is there any adjustments to be made before we go and we try and finish off the rest of the question? If we look down to the question, what are we told? Information. There's some intergroup trading here. So Jan sold goods to Donkla. So we know straight away that's intergroup revenue, intergroup costs. But because we're not doing an SOFP, we're not worried about making those adjustments. What we are worried about is any unrealized profit if any of those goods are still in inventory. And we're told 90,000 of those goods are still in inventory. So we look at inventory, 90,000, and we want to figure out how much is the unrealized profit. So unrealized profit. So we know 90,000 is what's remaining in inventory. We know they were sold for cost plus 20%. Therefore, what the cost price was, even if you want to look at the cost price first, the cost would have been 90 over 1.2 means 75. Therefore, the unrealized profit on that inventory is 15,000, and that needs to be stripped out. So the next thing is to figure out, well, who sold it? It was sold from TAccount to Dankla, therefore from the parent to the subsidiary. Therefore, the adjustment to profits will be in the parent's retained earnings. So debit retained earnings parent of 15,000, and you will credit inventory 15,000, and you can call that unrealized profit on intra-group trading. So you have that now. You can call that whatever you want. Note 1. That's adjustment 1, and you can bring that up here. So you know debit retained earnings, and we call that adjustment 1 of 15,000, and also credit inventory. So you can see once the things are set up, it's very easy to then just drop in the relevant adjustments. Whereas if you're doing columnar method, you'd have to try and remember to make that adjustment at the end, or you might use columnar on the face of the financial statements, which may make it a bit messier, particularly when you have a lot of adjustments. And that's 15. So that's adjustment 1. We're looking now for any other adjustments that are required. You're also told that it owed TAccount, so Dankla owed TAccount 100 grand in relation to the purchase of these goods. So that is an intra-group balance, and so that also needs to be stripped out. So we will credit trade receivables of 100, and we will debit trade payables of 100, and call that removal of intra-group balance. Because otherwise your trade payables and your trade receivables would be overstated if you did this, or if you left it in the consolidated statement of financial position. So we call that adjustment 2, 100, and we go over to trade payables, and we call that adjustment 2, 100. And the final thing that you should do then, just to make a double entry, just to show that you know where it goes, is 3, the recognition of the NCI post-acquisition profit. So we've calculated already up here, but just to show that we're going to put it in the accounts now, we don't forget about it, is we will debit retained earnings 48,000 and credit NCI 48,000, and that being post-acquisition share of profits. So we call that NCI post-acquisition share of profits. So that's adjustment 3. Is 48, and we go to the NCI adjustment 3, 48. Okay. So now we've all our adjustments done, and we've all our accounts figured out. That what we'll now look is for the balance to take off for each of the accounts. So for ease, I'll start my statement of financial position just over here. So we call it statement of financial position, year ended 31 December 2013. And we call, I'm just going to do it shorthand, but again, if you have time in the exam, make sure you do it out longhand. PPE is the first one. Now we didn't make any adjustments for PPE, and this is one of the, once you start practice with double entry, the TAccount method, some of the accounts you'll know from reading the question firstly, there's no adjustments required, therefore just simply add them together. So the PPE becomes plus 2660 plus 1140. So the PPE becomes 3,800, and there's no separate adjustments required. That's because when you become more experienced in these type of questions, you'll know which accounts you need to do and which ones you won't. You'll always need to do cost of control and retained earnings, etc., but some of them you'll not. The investment in Dankla we've stripped out, but we also know now we have a goodwill account from over here, and that is 240. So we now have our goodwill done, and the total on our non-current assets becomes these two added together, 4040. So we now look at our current assets, our inventories, trade receivables, and cash. Well, cash is the easier one. We didn't do any adjustments there, so let's just add them in and take them away, and put them in, should I say. Trade receivables, we did do an adjustment or two. So the closing balance now, so we call it closing balance, we also call it balance carried forward, is these two added together minus the 100. So the closing balance, which is obviously going to be the opening balance on the debit side, is 1090. That's our trade receivables. And finally inventory, we've also done here, your closing balance will be the two added together minus the adjustment, which is 1065. And you add your current assets together to get you to 2765, giving you total assets. So one benefit I like of doing the TAccount method is, once you do your statement of financial position, which you can leave as a separate blank page, it's very clean looking. There's no separate columns for different workings and figuring out what goes in where, and it doesn't, if you make a mistake, at least it's not shown on the statement of financial position. So again, it does take a certain bit of practice, but I think it's a lot cleaner, particularly when you get to complex questions, how to deal with certain items. So now you're looking at equity and liabilities. First thing you're going to look at is equity. So we call it ordinary share capital, share premium, reval reserve, and retained earnings. So we look at ordinary share capital. It is going to be closing balance is obviously this side because it's a credit. This 440 minus 80. So you'll notice that the only thing that's stripped out is the 400 has disappeared because that was related to Donkla. So the equity now is 4,000. See here. The share premium, well, the share premium is the exact same. 100 is only to Donkla. That has all been stripped out, therefore there's no share premium. 0. There's no revaluation reserve because the same situation. TAccount Jan had nothing. It was to do with Donkla. And retained earnings, which is the most complex, is already done for us. So all we have to do is add it up. And you're looking for here closing balance or balance carried forward. You have the total on this side, which is the bigger one, minus all the adjustments required, meaning that the total of the retained earnings which will be brought forward. So for example, you have it here as that, and then you have opening balance, which will be here, is 1267, giving a total equity of 5267. Then the other item that you might have forgotten just by looking at here is the NCI. So you have an NCI account, and that's why it's useful to have all these open, because when you're looking down you say, right, we have a cost control done, share capital done, retained earnings done, and you come back here and you see here NCI, and the closing balance in the NCI is essentially the sum of all these adjustments, which is 238. That gives you total equity of 5505, and then you have current liabilities, which is only your trade payables, and that will give you total equity and liabilities. So you have no long-term liabilities. Trade payables, well, we can work over here. We have the T account already done, and it is 400 plus the 1300 minus the 100. So you notice that the only trade payable that Donkla has is an intercompany that we've already adjusted for. Therefore, the only trade payables that will show up on the consolidated statement of financial position will be that of the parent of 1300. And hopefully, if we've our maths done correctly, both of those added together will give you 6805, meaning both the assets and the equity and liabilities are the same. So again, that was part C for 21 marks, set out the consolidated statement of financial position. Now, some people may prefer the column method, but I think from the perspective of keeping your adjustments separate and itemizing them 1, 2, 3 as adjustments and bringing them in then to T accounts, it's a lot cleaner both for you in the exam setting and also then to let the examiner follow how you're doing it. And particularly for the CA, where you won't have as complicated group accounting questions, it's a good benchmark to start, because when you move on to the full CAP2 financial reporting exam, you will have a lot more complicated adjustments, and you need to be able to keep track of those in a fairly methodical manner, so you can accumulate them into statement of financial position or other financial statements as well. So that was question 2 on the January 2014 interim assessment, TAccount.